So if we say that it now hedge accounting is so much of an easier task than it was in the past, I still go back to some of the objections that I get, and people are a little bit worried about it. So surely if you introduce a new category of reporting, there's going to be some sort of cost, there's going to be some sort of transition that you would have to incur. Can you give me an idea of just like how burdensome is that? How would BDO address that as a partner in that situation? And maybe which ones are overstated versus which ones really need some respect?
And that goes back to the example we were using a few minutes ago about tax planning. The real burdensome, when you say burdensome, I mean that's somewhat subjective, right? I mean, what really is burdensome to a company versus what may be burdensome to one may not be burdensome to another, right? So look at it. Let's look at it from the perspective of what's required. When you start talking about what's required, you're talking about documenting the actual hedging relationship and then quantifying it in a form of a test. So those are the two main elements that you have to address. Okay, understand there's requirements and criteria underneath those, but those are the two main elements. Once those are done, going forward then, depending on how you structured it, and if the work was done up front, you don't have to worry about a lot of that anymore. You don't have to worry about documenting much after the fact, after the instrument has already been put in place. You don't have to worry, depending on how it's set up. If it's set up to the point, you may get away with just doing a qualitative test after the fact. So really you won't have to do any sort of a quantitative effectiveness test or anything along those lines that people used to scare people. So when we talk about setting it up properly, the expectation is that you set up everything on the front end. That way, once, like I said, the transaction occurs, you really don't spend a lot of time managing it. Yeah, you're going to look at it. You're going to see everything is working the way it should be working. You may have to sign some sort of a statement, that qualifying that, that none of the terms have changed and what have you. You may have to take a look at just the credit risk of the counterparty involved. But those are rather minimal amount. They don't require much effort. So that's really the way you want to address it. The cost and the effort should be a little bit more upfront. Once it's done, managing it, administering it really shouldn't require that much time.
It sounds like that pre-work. I mean, BDO is in a perfect situation to be able to advise on how you set that up. To us on the front end, a lot of it is about systems and setting up counterparties and more of the tactical stuff. What can go wrong? So you implement a hedging program. From your perspective, what are some of the mishaps, things to watch out for, things that could surprise you?
Well, the two big things are the items I just mentioned. One, making sure that the documentation is proper, and two, making sure your quantitative test reflects what you are trying to do. So when you look at the standard itself, the standard is very documentation based. So when you start talking about hedge accounting, you get away from a lot of the other concepts in accounting related to materiality and some of these other concepts that people always want to toss around. Well, that amount's not material. In the hedge accounting world, it doesn't matter, okay? That any amount in hedge accounting world is material. It matters. So the documentation is one of the key drivers. If you can document it well to the point that it explains what is occurring between the two instruments, and it explains how you are going to administer it and manage it, and it explains how you tested it, all those various elements should be part of that documentation. I should be able to go in and pick up that document and have a very good understanding of what's going to happen with that hedge when I read it. If I can't, or I've got lingering questions that potentially may cause some concerns, well then it probably wasn't documented the way it should have been. That's the biggest determinant right there. Because once you have it documented, laid out properly, then the next question is, how do I test it? Okay, laying out a quantitative test. How do you determine how effective this particular derivative is going to be in matching what it is trying to hedge. There are ways to do that. There's various approaches. The approach that you see that is pretty much the industry standard is what we call a regression type of approach. It's a statistical sample, a statistical analysis, and it's laid out specifically to address the changes in movement between the hedged item and the hedging instrument, which is the derivative. How are those going to move? How effective and how well aligned are they going to be? And depending on the results of that regression, that's going to tell you whether you have what they call a highly effective relationship. If it's highly effective, you've passed the test. So those are the two big drivers. Now, the question is, if you don't do those correctly, what can happen? If you don't do it correctly, you could potentially have the situation where your auditors take a look at it and may want to not allow you hedge accounting treatment, which means your financials are going to change. Or you could have even the situation that's worse, which is you've gone through, you've used it, you've actually implemented hedge accounting treatment. Let's say you didn't go through all the right steps, and you presented financials now, and now the question is you're going to have to go back and basically restate those financials as a result of the fact that the treatment has changed. And what's going to end up happening is you're going to spend a lot of time and effort, first of all, changing your financials, and then two, having your auditors finally, opine and sign off on those financials in the end.
So it's interesting to hear, like, you talk about economic reality in terms of reporting. I talk about economic reality in terms of trading. And they work
well,
really
we're actually talking about the same thing,
yeah,
right?
Exactly.
In the end, we are. I mean, we're talking about really, in essence, is it doing what it is expected to do? Is the instrument really reflective of what you're trying to capture? And that's the driver of why you're entering into these instruments in the first place, is to mitigate risk, to stabilize cost structures, to really, in essence, achieve the stability as far as in cash flows that you want. All of those things come into play when you start looking at entering these instruments. And like what you were saying, a very good example, like what you were saying, is you're looking at it on the totality and the overall risk you have. A very simple example that I always tend to use when I talk to clients is, let's take, we're talking about a company that has international operations, and you have you're selling various types of products in let's say in the Eurozone. So basically you're bringing in euros, converting that to dollars, but you're manufacturing these products in Mexico and in Japan. So now you're exposed to two other currencies that you're paying your expense side on. You have a lot of cost going into the production in Mexico, a lot of product coming out of Japan, you're paying in yen. So the question is, if you have exposures to, on the expense side, to the Japanese yen and also the Mexican peso, and you have exposures on the revenue side to what is the euro, how are all these, some of these may be benefiting you and some of them may be hurting you? The question is, what is the overall exposure that you have? Because you have to look at it in the context of, wait a minute, there may be certain currencies that are benefiting me, and there may be some that are actually hurting me. And when I look at it on an aggregate basis, that's what I want to be hedging. That's the exposure. So in the old days, it actually used to be a little different. In the old days, they used to break it down and try and address it one by one, which is, it's a lot tougher, it's a lot more burdensome, it takes a lot more time. Now they look at it a little bit more holistically and look at the exposure overall and say, how can I address really what is my risk? What is actually impacting me? And that's how you want to hedge.
Couldn't agree more.
Yeah.
We've talked about financial reporting here so far. I just want to not exclude our treasurer friends. There's always cash to think about. That's one of the pitfalls that we address too, is that you think about all of your FX flows, your cash flows in different currencies, and there's also timing involved. One of the things that I like about hedging is that it's so flexible, whereas I can set my payments, whether I'm receiving cash or paying cash to a counterparty, I can set it up so that it matches my cash flows. Of course, that's something that we do very tactically, contract by contract. Is that something that you address from an accounting perspective too, or is it kind of like too low level?
No, actually, it does matter, because the timing of the cash flows is important. When you look at valuing an instrument, when you look at addressing how effective it's going to be, a lot of it really stems from the actual movements of the cash flows. So if you really look at it from that perspective, if you are a very simple example of that would be, let's say you're paying an instrument and you're paying it out on a quarterly basis, but the instrument that you're using to hedge it with is actually settling and paying monthly. There are going to be differences in those cash flows, and differences in the rates that you're using to affect those payments. So that is a crucial element of determining if it's effective for accounting purposes, and how you actually address that effectiveness. Because if it is effective, it's going to run through, and you actually get that certain type of treatment. But the cash flows are very, very, very relevant to it, because that really in essence drives, is the instrument really in the end accomplishing from a cash flow purpose? Because let's be honest, Matt, the end result is, once the cash has changed hands, did we gain from that instrument? Did we lose from that instrument? Did it accomplish what it was meant to accomplish? A lot of what we're talking about right now is more what's happening in the meantime up to that point. But the cash flow is what's going to drive it, yes.
Very good. So when every day when prices change, I mean, you can look at forward pricing for each commodity, and you can get an estimate of the timing and the amount of those cash flows when they're going to happen. And so when what we call a mark-to-market report, where you're saying, hey, what was the change in the commodity price and how does it affect my future cash flows? You can produce those actually during the day. We do most of ours at the end of the day, but we do them every day. From an accounting perspective, how often do you need to do it? Monthly, quarterly, daily?
The requirements say that you have to at least address effectiveness quarterly. So let's look at it from that perspective. Yeah, if you're talking about a public registrant, they're subject to quarterly filings. Yeah, they would have to do it on an at least quarterly basis when they are reporting. We do deal with companies all the time that do it more monthly, just because it's easier to manage. And as a result, it gives them a better perspective of really what's occurring on a monthly basis versus waiting to the end of the quarter. The other thing that we do is, and I actually had an instance like this just a few days ago, when a client was talking about the differences in addressing items like that quarterly versus monthly. And the difference was that they were losing some of the visibility related to their forecasting as a result of the fact that they were waiting till the end of the quarter. So if they felt if they shortened the period, if they reported more on a monthly basis and actually updated a lot of these changes monthly, that it would really allow them to update their forecasts a little bit better and give them a better picture as to really what's going on, as opposed to waiting till the end of the quarter. But the requirements say quarterly, yes.
Yeah, that would drive me crazy if I had to wait till the end of the month to get any report.
Yeah.
I would say that if you're in accounting or treasury and you have to wait more than 30 seconds to know what your cash flows are going to be, you have the wrong system. Like, for sure, all that data is available. It should tie in right into your corporate model.